Hi, I'm Rick Kaler. Thanks for joining me. A few weeks ago, when the U.S. market started dropping dramatically, a reporter for the Wall Street Journal called. He asked me if I had received any calls from worried clients. I told him that I'd heard from about 5% of my clients. "What changes in their portfolios are you making?" he asked. "I'm not making any changes to my investment strategy," I told him. I expressed some amazement that I wasn't doing something. Most investors and their advisors he was speaking with were making adjustments to their portfolios. He told me I must have a stomach of steel. Well, hardly. My gut is certainly not immune to those fearful, sinking feelings that go along with market plunges. What I do have is enough experience to trust my long-term investment strategy. The time most investors and advisors decide that an investment strategy just doesn't work anymore is when their portfolios lose value, usually due to a decline in the U.S. stock market. Now this confuses me, and here's why. First, I'm confused that so many investors believe it's possible to move in and out of markets in such a way that their portfolios will rarely, if ever, suffer a negative return. This is magical or delusional thinking, in my opinion. The only investor that I'm aware of who consistently produced positive returns year after year was a fellow by the name of Bernie Madoff. If you've never heard of this investment wizard, he's the one who's now serving a life sentence in a federal prison for propagating a Ponzi scheme that robbed billions of dollars from investors. Short-term or moderate-term losses are inevitable in any portfolio that seeks to earn returns above those offered by a bank certificate of deposit. Usually, in the long run, markets recover, and so does your portfolio. But sadly, too many investors turn short-term losses into long-term losses by abandoning their investment strategy when the U.S. markets turn down. This locks in their losses, never to be recovered. If your portfolio is widely diversified among many markets like bonds, emerging markets, commodities, real estate, Treasury inflation-protected securities, called TIPS, and various investment strategies, you will almost always have an asset class losing money. You will also almost always have an asset class making money. If not, you probably don't have a diversified portfolio. Now here's the second reason that I'm confused. Most investment strategies assume that the U.S. market will decline, and they have a strategy in place for dealing with those declines. For a buy and hold advisor, the strategy is to do absolutely nothing. For a strategic asset allocator like myself, it's to set targets and rebalance frequently by selling appreciating asset classes and buying into those that are into a decline. By not making changes to a client's portfolio during a market decline, I'm not doing nothing. I'm simply continuing to follow a predetermined investment strategy. Now, because most of my clients have learned over time to trust this strategy, relatively few of them make panicky calls to my office during downturns. Yet I've noticed a direct correlation between U.S. stock market declines and my daily phone call volume. Many of the calls are from reporters wanting to know, what am I doing and what am I telling clients? My response, that I'm not doing anything different, is the same thing I told them when markets last declined in 2011 and before that in 2009 and 2008 and 2002 and 2001 and 2000 and 1997, on and on it goes. Now, this isn't the response an anxious client or a concerned reporter wants to hear. When the emotional center of the brain is overcome with panic and fear, taking action helps relieve anxiety. That short-term action is selling into volatile stock markets. it often turns out to be a long-term mistake. Thanks for listening.